The current market pullback is relentless. Most investors know that stocks will bounce back sooner or later, but how long will this bear market last? How far will it go? And what are the safe haven stocks to buy right now? I'll answer all three of these in this video. My name's Henry, I work for Wall Street, and although I don't really know what's going to happen for sure, my track record on YouTube has been pretty good beating the market in my Discord over the last year, and I've never really pushed junk stocks or hype because I take this YouTube thing seriously. If you appreciate that, like and subscribe. We're on the road to 200,000 subscribers. Henry, is the bear market going to continue? Unfortunately, there's no clear answer, but I'll tell you shortly why this looks a lot different to me. We can gain some perspective by looking at historical market downturns. Significant declines aren't really unusual for the S&P 500. They happen regularly at varying levels of intensity. The worst type of market decline is a bear market, which is defined as a period where the stock plunges by 20% or more from the most recent high. Stock market corrections are more common. They occur when the stock sinks at least 10%, but less than 20%. Bear markets tend to last longer than corrections do. The longest bear market for the S&P 500 occurred during the Great Depression and lasted 2.8 years. Since the 1950s, the longest bear market was in the early 2000s when the dot-com bubble burst. It lasted 2.1 years. Corrections rarely last for more than a year. The current S&P 500 sell-off appears to be primarily due to two related factors. Inflation is soaring, driven by virus-related supply chain issues, and high fuel prices resulting part from the Russian invasion of Ukraine. Interest rates are also rising as the Federal Reserve attempts to keep inflation under control. Both of these factors do seem different to me, with interest rates set to continue rising and no stop to the war fueled by support from both sides. I'm concerned this could be one of the worst we have seen in the past decade. However, that means we have about a 10% further decline, and that could happen into 2023. Not good, but also not too bad unless you're going to retire in less than 5 years. What I don't like as an investor, and this should come as no surprise, but the Federal Reserve job is to keep employment at a maximum, stable prices, and moderate long-term interest rates. They do not have an obligation for your personal investments or the stock market. We have to do that work out here by ourselves. Because of that, I recommend a number of things: hedging your portfolio with options, buying less risky stocks, and cutting back on weak balance sheet stocks, and also dollar cost averaging and creating more income. For hedging with options, I'll leave a link in the description for a video that I made. Hedging can be done a number of ways. You can buy a put option to protect your downside risk. You can sell covered call options to gain some premium. That gives you a margin of safety in your portfolio. You can also do a number of spreads. There's call credit spreads, which I'm going to link in the description. A call credit spread is when you sell a call option, buy another call option. It's a very tiny position. Typically, I will make $500 spreads in my Discord community, and these $500 spreads will typically collect maybe $80, $90, or $100. So I'm aiming for a 20% return in about a week or two, and this is to hedge their portfolio. Lately, these hedges have been doing very, very well. You can also buy a put debit spread. That's where you're betting on a stock going down, just like buying a put option. But when you're opening up a spread, it may be a lot cheaper. But when you're opening up a spread, it is a lot cheaper because you're buying one put option, and then you're subsidizing that put option by buying another put option. Spreads are oftentimes way cheaper than just buying options, so I do prefer spreads when I'm buying them. And I also prefer to sell a lot of spreads as well to create a hedge in the portfolio. Again, there's a lot of ways that you can hedge your portfolio. I've recently been covering on this channel how to do that, so make sure you look at my playlist. Now, as for stocks that you can invest in, one of the best stocks that comes to mind is Starbucks. Starbucks is going to do very well because people are coming back to work, and with lockdowns passing, this will be a positive foot traffic effect for Starbucks. Now, I don't know about you specifically, but there's a lot of people out there that just go ahead and waste half of their paycheck on Starbucks. It seems insane to me because Starbucks seems very overpriced, yet people really like the atmosphere, people really like the brand, people really like their coffee, and they're diehard fans. This is also not Starbucks' first correction or even market crash. Starbucks has been around for some time, and they've been through a lot of tough times, yet customers continue to go to their storefront. And the most front and center advantage Starbucks has is the incredible loyalty of their customers. Loyal customers are the most important thing in a business. It's not about getting a lot of money fast. It's about having a long-term client with a high long-term value. If that customer keeps coming back and valuing your products or services, or for example, in Starbucks case, buying your coffee, this is very good because your business is going to continue to cash flow well into the future because your customer is happy with your product, service, or information. No amount of inflation or price hikes has scared away the company's faithful customer base. And I expect these customers to continue being faithful to Starbucks because of their brand, and because even if prices go up just a little bit, people still really want their coffee, and too many people are lazy to make their coffee at home. Now also, maybe it's just the experience. Starbucks gives you a very positive experience when you go inside the store. The company's innovation can't be overlooked either. Promoting healthier food options and redesigning the drive-through ordering boards to suggest high-margin food and drinks pairings should also lead to a lot of results. In fact, Venti-sized long-term results for shareholders. That's because Starbucks is copying the likes of McDonald's. So McDonald's will ask you, would you like a drink with your order? Would you like to increase the order from a medium to a large? Starbucks is doing something called cross-selling. So when you're ordering a coffee, they may ask you, would you like anything else with it? And typically that something else is a very high margin good. So I bought some cookies and other stuff at Starbucks, and that increases the order value, because if you're buying a $5 coffee and you buy something else for like $2 or $3, that's actually a 50% increase in the order value. So Starbucks for me is a very high conviction stock. I think it's sold off a lot, and in this bear market, I would look into investing in companies like Starbucks that have wide moats and have been sold off and have very good valuations on the fundamental side. The next stock is Meta. Facebook is trading at its cheapest valuation since becoming a public company in 2012. Like Starbucks, Meta has a whole list of near-term challenges, including Apple's iOS privacy changes, heightened metaverse spending, which weighs on profits, of course, and growing concerns that the US will enter into a recession, possibly. However, none of these headwinds alters the company's strategy or hinders its double-digit growth potential. People are still using Facebook, and advertising is very lucrative. So many brands out there are scaling through advertising. In fact, my videos have video ads from YouTube, and I'm sure you've seen a whole different list of ads. I don't typically like buying things from ads because I like to do my own research and I like to have more of a personal connection rather than being hit by an ad. But sometimes those ads are useful, and certainly even if you get 1 out of 1,000 or 1 out of 2,000 people to buy your info product or service, and typically these info products are $4,000, $5,000, $6,000 Shopify stores or Amazon FBA courses, or some type of service like running your ads or automating your business, some type of high value service or information that is probably in the make money niche. These are very expensive services with very high profit margins. So even if 1 out of 2,000 people or even 1 out of 3,000 people buys that service or information product, it is still very profitable for the media buyer and the ad spender, that person running those advertisements, to continue running them. Because typically, I'll tell you how this works because I've been on both sides. I worked at a Google PPC agency where they were buying ads, and also as a YouTuber myself, I do get paid from AdSense. So let's just say it costs a business like $50 for 1,000 views. And from those 1,000 views, you get, a few opt-ins. Let's say you get like 20 people giving you their email. Well, when you send an email asking them to book a call or for you to learn more about their service by watching some type of webinar, this ends up getting you a few qualified leads, let's say 3 leads. Now, if you just close 1 out of 3 leads and show them the value that you have to offer them, well, now you have made a 2 or 3 or 4 or even maybe a $10,000 sale. So it doesn't really take that many customers to make a lot of money. If you're interested in this type of stuff, you can always message me on Instagram. I only have one Instagram. There's a lot of scam accounts there, but my Instagram is in the description. I love talking about business outside of investing. Something often overlooked with Meta is that the company hasn't even meaningfully monetized all of their core assets. Virtually all of the company's advertising revenue derives from Facebook and Instagram. If and when CEO Mark Zuckerberg pulls the lever on monetizing Facebook Messenger and WhatsApp, the company's growth in operating cash flow can really kick in a lot higher, and this company will make a lot more money. Given Meta's incredible operating cash flow and its aggressive investments in the metaverse, a forward price earnings ratio of 14 makes it a great value stock in a market sell-off. Now, keep one last thing in mind. The best thing that can happen in your 20s and 30s and even 40s is a stock market crash. For you 30-year-olds and 40-year-olds who are making probably a lot more money than you were in your prior years, you can add to the market and dollar cost average lower. For the older gentlemen and ladies, you need to hedge with options as much as possible, but also you can dollar cost average as well. There's many ways to hedge. Check out this video right here and check out my option playlist for more.